Hello and welcome to yet another session of TechnoFunda. We will discuss thoughts and TechnoFunda strategies on navigating uncertain times. Here is a quick disclaimer.
So we'll start with the recent situation of Corona, and then we'll reflect on the situation, try to see how to identify strength. There is an evaluation of wave theory which we'll be discussing, how to assess risk reward across sector and size of companies, and then finally some strategies on company selection. And then finally learning from history, which will be taken care by Saurabh. Now the first point, that is starting point. So this is the phase we are in, and we'll reflect on the current situation very briefly. Here are the thoughts around the situation, for me at least. We don't know what this is, right? And most of us don't know what the situation is because there is no precedent on the same lines which has happened in the past, right? So the situation here is we don't know how long this will last. We don't know how soon a drug or a vaccine will come out. We don't know whether new cases will accelerate or not, right? Even for tomorrow, I don't know what will happen tomorrow, day after, how many number of cases will come out. We don't know how will market behave in the near term, right? And we don't know if lockdown will continue in India, whether fully or partially. Having said that, it's better to know that we don't know, because then you can start reflecting on the situation and try to get the answers in best possible way around how to navigate the situation in a proper way. Now, the idea is basically being prepared. That's what we will ponder today. We will not spend time whether 1 month lockdown is there, what is the near-term effect. If 2 months lockdown is there, what will be the effect? If the number of cases jump by 10%, what will be the effect? We will not be discussing that. I think the entire day you must be listening to all this stuff any which ways. So let's get into the positive side of it, that how can we better prepare to deal with this situation, and that's what we'll ponder in next 1 or 2 hours until the presentation lasts. Again, the caveat is the presentation is slightly longer, but I hope will not be a boring session. It will be much interesting session, and we have tried to make it as much as interesting as possible. So having said that, it's time to reflect and try to see what best we can do in current scenario. Basically, it's time to reflect, and when we take time to reflect, the necessary actions naturally follow, right? Now, first thing is to know ourselves, to see what kind of job profile we are in, how much risk ability we are able to take, what is our time horizon in terms of investing, what is our current asset allocation, are we heavy on fixed income or are we already heavy in equities? Are we having a backup plan in terms of if things go wrong? Are we balancing the portfolio prudently if there is a proper asset allocation that was in place but now that has changed? Are we rotating within the existing set of portfolio companies? And also we will try to understand what is risk appetite we should be taking and emergency cash if at all we need, right? So the top priority in such times, whether it is Corona or no Corona, right? It's basically for self, the top priority is survival, right? And if you reflect about individually, whatever attractive level market might look like or whatever further it can fall, we don't know. But first thing is very sure that you should be prepared for survival, right? And for that, I would prefer, at least personally, that I have at least 1 year of emergency fund. And 1 year of emergency fund, what I mean is, if say for example all the incomes become zero, can I survive for at least 1 year on all my regular expenses? And the regular expenses are particularly your normal operating expenses, your rent if you are staying in a rented house, your EMI if you have taken a car loan or a home loan, your children's school fees, and your utility bills, right? So these are the basic minimum things which you require for survival. So before doing anything else, if this is not in place, I would, at least personally prefer that I have at least 1 year of emergency fund. Now, same thing, if you think about it, applies for the companies. So again, we dealt with the first slide that we don't know how long the situation is going to last. Assuming that for the company as well, that we don't know whether the corona situation may last for 3 months, 6 months, 1 year. We should assume that what if the company's revenue goes to zero? Are they able to survive for at least 1 year? Right? And this exercise again helps us in a longer term as well. If my company is a stronger company and can survive a 1 year of zero revenue, probably in the future also it will be much stronger and can handle a lot more stress if there are any similar situations in terms of financial or economical stress which they came across, right? So the second point on the company side is basically assume that the revenue is going to be zero for next 1 year, and then assume whether the company will be able to pay normal operating expenses, employee salaries, any interest payments if they have taken loans, any regulatory fees, and any other fixed expenses. So basically, except the variable expenses, we should assume that all the expenses are there and there is no revenue, whether my company is able to survive for 1 year or not, right? That is the criteria which I tell as capacity to suffer, and this is the first and most important top priority that we should have in mind as an investor. Now, how to check this, right? So here I've given a quick example of a company called Whirlpool. Again, this is not an investment recommendation. It is just for explaining the concept. So please do your own due diligence and don't take any investment action based on the examples which I share. Right. So let's try to see how does it look. Right. The three parameters which I have mentioned. Right. So let's go to a screener and try to see Whirlpool India. Now the first aim should be to go into expenses. So we go into yearly expenses to see 1 year effect and just split this, right? So what we should be looking for is mainly the say fixed kind of expenses. So I'm assuming these other costs are fixed as of now just to be conservative, and these 9% of salary expenses, which I am again assuming as a fixed cost, right? Now we assume that revenue becomes zero, right? So there is nothing coming up here, say for example, and then on the latest expenses, that is 5,000 crores, what is the percentage of such fixed expenses? So that is roughly 25% if you look at it. So my compulsory expenses, which I showed on this slide on the bottom, that becomes kind of this ballpark number, that is 25% of my regular expenses, right? So my regular expenses are kind of like 5,000 crores, and if I do say 25% of 5,000 crores, that will roughly give me around 1250 crores, right? So that is where we are right now, right? So let's keep this figure in mind for now, that it's 1250 crores if I'm correct in terms of calculation, right? It's 1000 is 25, yeah. So it's roughly 1250, right? And now going back to the slide, the second step we should be looking at is in terms of borrowings, right? So ideally we should prefer in this kind of situation that borrowing is zero. And if we just go here, that is taken care of. So I don't have any interest payments or any EMIs which a company need to pay, right? And then third thing we should be checking in terms of the survival is on the balance sheet, that how much cash we have or any kind of liquid investments, right? So if I check here in other assets and come down over here, cash equivalents is roughly 1300 crores, and there might be some more smaller investments which might be liquid in nature, right? So that roughly take you to somewhere around 1700 crores, right? So that means that if company is able to, is going to survive or not. That means basically it requires 1250 crores, and on the balance sheet we have roughly around 1600 crores. That means that even if we don't have any revenue for next 1 year, we will survive, right? Now we'll take deep dive into strong sectors and business models, how to find, right? So the idea is basically look for strength, right? Because if you are surviving and you come out stronger during such times, that is what we want as an investor, to invest in such kind of companies, right? So strength is life and weakness is death. This is for life, but then pretty much similar case in terms of companies as well, that the stronger companies will come out much better in future, and we should be looking in terms of strength both fundamentally as well as technically in terms of price volume action, right? So that's what we are deep diving into now. We'll try to understand how to get a balance sheet strength and the business model strength in place. So first and foremost thing, as I mentioned, is staying away from leverage, right? Any kind of leverage can cause trouble. So if you think for self, this is again not a time to get into leverage. So let's stay away from leverage plays like F&O. So don't just buy any position in margin and just expect something to happen overnight, because we have seen a lot of volatility is there. The IV is very high, right? And we have seen how the fluctuations in prices are there, particularly if you have seen the crude oil prices on Friday, I think last week. It was humongous. It was like 30-40% spike in just few minutes, right? And we also seen a bounce when there was a lower circuit and the Nifty bounced back to 1,000, 10,000 points. It was a 1,000 point candle in just 1 or 2 minutes, right? So if you are in such situation and then you are leveraged or having a margin call, it is very difficult to survive in this kind of situation, and this is not the time to do those kind of leverage plays. Second is we should review our asset allocation and deploy only as much as we can afford, right? So we should again not go overboard thinking it's too cheap and try to disturb our overall asset allocation, and also try to avoid asset liability mismatch. Again, I'll explain that point in the next slide, but this is very critical point which most of investors miss out. Probably people become very greedy and try to jump in, but we'll try to see this deeper in the next slide itself, right? And similarly, it follows for the company that prefer debt-free companies. We will need to review capital allocation, how they are allocating capital prudently, and the capacity to bounce back. That is again more of a price action and technical factors, and obviously the strength of the business model that will give us those clues whether these businesses will come out faster, whether they will survive and jump and bounce back, right? So that's what we are going to deep dive further. Now, this is what I was talking about in terms of asset liability mismatch, right? That our liability cycle may be short-term expenses or your EMI or any other liability for that matter. It could not be just a liability from taking a debt, but any liability in terms of normal life, how you are living, right? So if you have a near-term liability, say for example, after 1 year, you have to pay say 1 lakh rupees of kids tuition fee, right? And you have that 1 lakh rupees reserved for the next year. Now the market has gone to say 5,000 Nifty level. Hope it doesn't come like that. But just assuming that it comes to 5,000 Nifty and you see that the market levels are no brainer, right? And you probably think that, why not I just use this 1 lakh rupees for next 4-5 months, and once market bounces back, I'll book the profits and pull out that money. But we should never be doing that, because we don't know where the market will go, right? After 1 year it might be down another 30%, and that 1 lakh might become 50,000, right? So just make sure that whatever allocation, new deployment you are doing in equity, you are doing with a time horizon which you have in mind. If you're doing positional play and if it is just 3 months play, it's perfectly fine. But if you are doing a proper investing for longer horizon, you should not pull out the money which is there for your short-term liabilities, right? And that is the last thing you should be doing. And if you remember the NBFC crisis which happened during the IL&FS fiasco, that was probably because of the same reason. Companies, smaller NBFCs, even bigger NBFCs for that matter, were taking deposits for say 1 year, right, and lending to other companies for 5 year, 10 year horizon. So basically, companies assume that every year I'll get new deposits and I'll be able to fund my loans which I have given to the companies. But that didn't happen because there was ILFS fiasco and people refused to give deposit to these companies because the risk was too high, right? And they were struggling to fund their loan book and their asset cycle. And that is what we should be looking for, right? Because you have to again repay those money in your personal goals in the near term. You should never put that money in long-term oriented goals of equity allocation, right? So this is very important. Again, sometimes people become so greedy that they just pull out everything and as people say, sell your house and put money. It doesn't work like that in real life. Right, so at the end of the day, this matters the most, right? We need to have a good sleep at night. It's even prudent to pull out some cash even now if you cannot sleep at night properly, right? So review your overall allocation and see if you are not over allocated anything into the equities, and if you are not able to sleep at night properly, whatever levels are here, even if it goes higher by after 2 years or 3 years, you need to pull out some cash, at least that much that you are comfortable sleeping at night properly and peacefully, even if it falls further 20%. That is what we should be doing at this point of time, right? And now coming to the wave theory, how we are evolving in the current situation. This again I tweeted some time back, and I'm just explaining this concept more, right? So when the market starts falling, it's always people shun away the weaker companies. So if you have 10 companies in your portfolio, logical thing is you will shun the least likely son in the overall portfolio, right? The son who you don't like most, that will be kicked out first from your house, right? So same happens with the portfolio. People check out the companies which they don't like relatively in their portfolio, right? Obviously they liked all of them, that's why they probably bought all of them in the portfolio, but there might be again choices and preferences, right? So people will keep perceived safe havens like Asian Paints, Pidilite in their portfolio and kick out the other riskier allocations. That is the first wave that happens, right? And we'll see in the chart how that exactly happened, and it will be very, very easy to spot that in just one single chart, right? Second is the heaven starts cracking. So all these stocks like Asian Paints, Pidilite, which are perceived as safe havens, now people feel panicky. People feel that it is not the right time, and after getting away with all the small and mid cap and perceived risky stocks, they also start selling slowly the safe havens, and that is where you see these companies also cracking, but the volume is very low because people are just testing waters and they don't go all out, sell everything at just one point, right? And then the last final point where the maximum pain is there, and generally in all the cycles, at least 2008 I was there, I saw that people get so much frightened that hell breaks loose and people are so fearful that they want to get out of everything in equity at any cost, right? So there is a desperate selling by both retail investors, FII, as well as the mutual funds, right? And this generally happens with very, very high volume, and this is known as capitulation phase. And this is where most small and micro caps gets butchered like anything. And we have seen, and again Saurabh will discuss a lot on this by studying the history and what kind of company by how much percent, everything is there. But believe me, these kind of companies fall anywhere near 80 to 100%, right? So everything gets literally wiped off. So this is the chart which I was talking about, right? If you see in the first phase, where this is a dotted line where the first wave started, you see the Nifty fell almost like 15-17%, and your perceived safe haven actually got inflows, right? They were up slightly 3-4%. So your Asian Paints, Pidilite, Divi's Lab, all those perceived safe haven were slightly up. So basically people sold off other stocks, but they were probably moving their money to safe havens or just holding into it, right? If you see the second dotted line where you see the fall in Nifty further aggravated, this is where you will see that even the perceived safe havens like Asian Pidilite also started falling, right? And then you also had a divergence, in fact, in between the Nifty and the mid cap and small cap index. So the bottom two lines, which is purple and yellow in color, those represents your CNS mid cap index and the small cap index. And this is where you see the divergence that mid cap and small cap did not recover at all in the bounce back, and your larger perceived heavens started falling off, right? And the third wave which I mentioned typically will be with high volume. You will see a lot of mutual fund selling, right? So till now we had mostly FIIs which was selling, and initially FIIs selling was around 5,000 plus crores, and you had DIA buying 4,000 crores roughly every day, right? And if you see recently, the phenomenon has slightly changed, except 30 and 31st, where there was more NAV adjustment by mutual fund. The flows have drastically come down. It has gone below 2,000 crores inflows, net inflows I'm talking about. And then recently, if you see on 1st April, it was negative 450 crores, and then April 3rd was minuscule 200 crores. That clearly means that the net inflows are shrinking and drastically shrinking, right? And if this continues and you see 1,000 or 2,000 crores of net outflows from the mutual funds, and this will again take time, and this might or might not happen based on how situation pans out. If we find a new drug or a new vaccine, we might not see a SIP outflows in a drastic manner because these are sticky products. But if this scenario lasts longer and if people are frustrated, people are fearful, there might be SIP unwinding, and that might result into the third wave of fall where there will be desperate selling by mutual funds, right? Now, the first and foremost lesson from this is, at least if you have made up your mind to hold whatever portfolio you have currently and not decided to sell, at least the first thing you should be doing is rotate. It was first wave when smart people did. If you did, it is really fantastic. But if you haven't, I think this is again a good practice at any point of time. But in current scenario, at least, first thing we should be doing is getting away from junks and rotate to a better companies, the stronger companies, right? And we will come to it again, how to find those kind of sectors and companies. But this is the first thing we should be doing if at all we decide to stick on the current portfolio allocation, right? Now, how to find the future sector leaders, right? So this is beautiful quote from Mark Minervini in his book Trade Like a Stock Market Wizard, that the industry groups with a healthy number of stocks hitting new highs, right, early in the bull market will often be the leaders. So this is one clue we should be looking for, that this industry groups where you see many stocks hitting new highs, those will be the first one to make a leadership position and give the maximum percentage return in your upcoming bull market, right? And your portfolio should consist of the best companies in these sectors, and these should be top 4 to 5 sectors where you should be looking at, right? More often than not, the best stocks in the leading groups advance before it's obvious that the group or sector is hot. So again, this is very interesting clue that individual companies, right, best of those individuals, so market leaders on those upcoming sectors will start moving fast, right? And they will move first before the entire sector picks up and show you that sign, right? So first we should focus on the stocks and let them point to the sector which is your upcoming sector. And as soon as this overall fall will deteriorate, or once we start moving up, we should be looking at these signs, right? That which sector leaders are moving faster, right? And who is moving first, and then we should look for the clues of groups or sectors which are moving up and beating the index, right? So we should be comparing those with the market indices. So if the market indices ignore an extremely overbought condition after a bear market decline, and your list of leaders expand, this should be viewed as signs of strength. So you should be able to get bigger and bigger list of such leaders. That means that the bear market is behind you, right? So we should be looking for this clue to navigate further. And this is just one example, and this is again customized tool which I have built to get a understanding of price volume action in individual companies. And then I mapped those companies with a particular sector, and each day it shows a price volume action in a particular company. It basically turns green in the screen. So in the bottom what you are seeing is basically the date wise columns, right? And then on the bottom left, on the left column, these are the names of the companies mapped with the sector, right? And I have my customized criteria, and again I'm not going deeper into this topic. It's like almost 2 hour kind of just topic to understand price volume action. I took a webinar last year, and we have discussed this on length, right? And those who have attended that, they already know. And I've just listed down those courses here. So if you are interested, you can just browse through them, and you can basically try to understand how this works. But you can even devise your own strategies around understanding the price volume action. But the idea here is basically to try to understand that these kind of phenomena will happen, and it happens in every upcoming bull markets, right? And Saurabh will again take you through what happened in the past falls and how we have done in the last 10 years after that particular fall, right? So he'll give a good sense of such sectors which performed, and we all know that. But right now it looks in hindsight, but he has analyzed the data, how it looked in 2008-9, which companies bounced back first, which companies, sectors bounced back first, and that's how we can get a clue, right? So that is the thing. It is again being prepared of what is coming and try to be with the winning sectors. Second is assessing the risk reward, right? So this is very again interesting slide which I prefer to ask people, right? That what will you prefer in current situation, right? These are 3 options, and people probably can put their messages in chat so that it's interesting for everyone as such, right? So basically the idea is, first is your Raju Rastogi, right? So given a choice, Raju is basically a Sarkari Babu, right? So he is doing a government job. He earns 40k per month salary, and he has decent increment, and he has very good stability, right? We all know that people hardly get fired in government jobs, right? So this is one scenario, and again you have to see in context current scenario that tomorrow if you are going for a job and people, there are 3 different employers who are ready to give you a job offer. In current situation, in whatever lockdown and whatever we are facing, which one will you prefer so that you are better off in terms of investing, right? So first one is Raju Rastogi, government officer. Second one is Chatur Chove. He is a corporate, he's getting a corporate job offer, slightly higher salary of 60k per month, good increment, not too low, not too high, and medium stability. If things work out well, he might retain his job. Things go worse from here, he might lose his job. Third is Rocking Rancho, and Rancho is always adventurous and doesn't matter for him whatever risk he can take. So this is more like a startup job where you get 1 lakh per month salary. You get very high increment if your performance is very good. But if situation doesn't work out well, you might get fired or the company can go bust very soon, right? So it's a very low stability job. So as an investor, you have to think what is your risk appetite, where you see yourself if given a job offer, whether you will become a rocking rancho or you will like to be a Raju Rastogi or you like to be a Chatur Chobe. What do you like generally? I'm just waiting for a few responses on the chat box so that it's interesting even for me. It's very difficult to just keep speaking at staring at screen, right? So some fun for me as well. Right. So I think most of the people I see are preferring either a Chatur Chobe or a rocking rancho, right? And you might also be seeing the chat, and it's good. So it again slightly ties back to the overall thought process which I am trying to drive. And again, nothing is right and wrong here. So let's see the perspective, right? So if you are category where it is Raju Rastogi, basically you are very conservative in terms of investing, and if you are such conservative person, you should not be venturing into high risk kind of investments right now, right? So basically defensive places to hide, highly conservative bets, highly conservative business models with slightly lower return expectation is place we should be looking for. So your FMCG, your pharma, your utilities, where there might be much lesser drawdown, possibly some good returns in near term, that should be the place to hide for Raju Rastogi. Now for Chatur Chobe, it's the place to think of slightly longer horizon. Given that there is a medium stability and there is a balanced approach, right? Probably this guy is 50% invested into fixed income and has a cushion, doesn't have a loan. That kind of person should look for a pretty much value plus growth place and debt-free compounder. So not going overboard, taking too much of risk, but one who can take some pain in medium term, and then longer term you compound a lot. So strong sector leaders, compounders with near term issues, so something which might go away in like 3-6 months, or the company is strong enough to face those situations. We discussed the example of Whirlpool, right, where you can basically have a strength or the capacity to suffer in near term, and then you can compound in a longer run, right? So such kind of companies, again, just an example, not an investment advice to buy or sell. And any outliers in a beaten down sector. So say for example, I would give an example of logistic, right? So logistic is perceived as a asset heavy sector. People are in trouble. The labor has migrated to their hometowns. The situation is in mess. They are generally debt heavy players, right? So the entire overall sector as a logistics sector might have gone beaten down, but there might be one or two outliers in that sector which are probably asset light players, which are not having too many trucks on their books, they don't have any debt on their books, and those also have got butchered because the entire sector has got derated, right? So you can think of such companies which are outlier in a beaten down sector where the risk as a sector are high, but then your player which you are selecting is much better off in terms of business model as well as balance sheet strength, right? So that is the second category of Chatur Chobe. And the third category is rocking rancho, where basically you are willing to take a high risk. You think that if there is a back, I want to bounce first. So you go into risky small and micro caps, despite you know that wave 3 might materialize in future, right? And you might get butchered. Or if things turns out well, you might make a killing in very short term, right? So you can take high risk, high return bets. You can also play on SME, and that is again upon risk appetite. And another viewpoint to see this is, as a portfolio, you might have a combination of all three. So if you want to make a balanced portfolio, probably you want that 30% is in Rastogi kind of players where I protect my capital. Say 30 to 40% are in the likes of Chatur Chobe, where I want to compound in a longer run, and 20% I'm willing to risk that capital in the overall portfolio scenario, and I want to bet on these micro caps and SMEs and high debt players where if things work out, it gets re-rated very fast, right? So it's again individual approach, but this is something which we should be pondering right now rather than waiting for just the bull market to come and being clueless about where to go and where we are going, right? So that's it. That's all about it, right? Now, it's again important to take these decisions whether the sector or the companies which you are looking into, how it is affected and how things will pan out if this scenario continues in a longer term basis, right? So there is an interesting theory by Howard Marks, and we saw this in one of the chapters of The Most Important Thing, right? And he talks about thinking in terms of first, second, and third order effects. And most of us think in a first order effect, so we see immediate effect, what will happen, and that is again important. I'm not saying that that is not important, but we should also see the second and third order effects of the situations. And if we do that, I think we generally sometimes get ahead of the curve and can take decisions much faster. So, say for example, there are three, sectors, three buckets which we are, categorizing in terms of sectors. So, one, the sectors which are most impacted. The second, the sectors which are moderately impacted, and the third, which is sectors which are least impacted, right? Now, this is mostly the exercise we might all have done, right, in terms of trying to see, and it's generally pretty evident, right, if we think about it in front of us, in front of our eyes, because these are all first order effects. So you see, most impacted sectors are probably airlines, hotels, cinemas, restaurants, logistic players. On the moderately impacted players, you have mostly insurance, banks, industrial companies like L&T, right, and also some cement and auto kind of companies, right. So you have all these different sectors within moderately impacted category, and then you have sectors which are least impacted, which is FMCG, pharma, and utilities. And this is pretty much we discussed in the similar case in the last slide, right? If you think about. So when we discuss this point about Raju Rastogi and Chatur Chobe and Rocking Rancho, basically it was more from first order effect that if you want to go into the least impacted space, you should probably go into FMCG, pharma, and utilities. If you are Chatur and you want to take medium risk, probably you should be looking for sectors which are moderately impacted. And if you are a high risk taker like Rocking Rancho, probably you should look for the most impacted sectors. But this is just one line of first order thinking. If you dig deeper, there you will see patterns where you will find even within these sectors, some of the companies or subsectors which are even more risky, right? So think about that. If the lockdown prolongs for a long time, and people most affected are daily wage earners and people who basically are your Uber drivers, your maid, people who go on staffing based companies where the wages are just daily basis, people who are working in industries with a daily wage, right? So all those people might face a lot of difficulty if this scenario lasts longer for 2, 3, 4, 5 months. And even if we talk that banks are moderately impacted because they are online and all those things, if you think about it, the companies who are lended to these daily wage earners like your MFIs, your players like Bandhan Bank, right? So they will take a brunt, right? And if you think about a banking model, they work on 10 times leverage. So you might have 10% of your own equity, your own money. You have 90 rupees of your deposit money. So that 100 rupees, you probably lend 70 rupees bearing your SLR and CRR. So out of those 70 rupees, if even 1 rupee is NPA, 1% is NPA, you take a 10 times hit on your equity value, right? So if you go in a situation where your NPS goes say 10% of the entire loan book, you pretty much wipe off your 70% of equity. And no wonder people have now thought about those second and third order effects. And these companies are butchered, right? So Bandhan Bank was somewhere around 700 rupees, and this is not a fully again MFI play also. It is partly MFI plays after it got merged with Group. But still, from 700 rupees, it went down to 150 rupees, right? And the risks are there. So if you think about in a second and third order effects, I think you will visualize these risks much faster, right? And again, the thought which I want to leave with you in terms of second and third order effect is you should be again differentiating these sectors into various companies in terms of whether the loss of demand is temporary or permanent, whether the item which they are selling is a necessity or luxury, whether the player is an asset heavy player or asset light player, whether they have a very high debt and are they able to survive or not, how we checked about for Whirlpool, whether the company has a digital distribution or they have a physical distribution. So all these things will matter, and you should again diversify around these parameters when you are constructing your portfolio for a longer period of time, right? And this is now again one of the ways to see the strength, right? So mostly the perception is that value is where the fall is maximum, right? So this is a quick slide from analysis done by Alok Jain. Again, full credit to him. I have not seen the underlying data, but assuming that the data is roughly correct overall, right? You see that there are companies which have fallen the least, which have outperformed even Nifty benchmarks. So when Nifty has fallen say 30, 40, 50%, the companies might have fallen much lesser, right? So that bucket is obviously smaller. You have companies which has fallen 10 to 30% as 68, and then you have companies which has fallen 30 to 50%, that is 224, and then the companies which has fallen more, right? And if you map these with sector, you will again tie back to the last sectoral points, and you will find that the sectors which are least impacted, they might be falling in the top bucket. The sectors which are moderately impacted, will see most of them in the middle of these bucket, and the companies which are highly affected, again you should also overlay the aspect of small micro cap within this, but you will see most of these companies and all your junks within these bottom pile of the pyramid, right? Now most of us generally, when we start looking for the new winners, generally the thought process is that the company which has fallen the most, that is the most value stock, right? Because you have fallen 90%, 95%, और कितना नीचे जाएगा, ये तो double हो जाएगा, 5 times हो जाएगा, right? So those kind of mindset is there. Again, Saurabh will dig deeper into telling you with data and with all statistics how it has panned out in the last decade. But this is the last space we should be looking for, right? So the companies which has fallen 90 to 100% in this kind of fall, probably that is not the space we want to be, right? People might say that airline is a value buy right now that has fallen very heavily, PVR has fallen heavily, but you don't know how the situation is going to pan out, right? And even Warren Buffett is selling airline stocks. Why do we want to fight with the market and try to buy the stocks where market has just dumped it like anything? It has butchered 90, 95%, 100% in some cases. Why do you want to get into something which has been totally butchered by market? And market generally is not wrong, right? If they have done something, there is some action by market. We don't want to fight with the market, particularly when we have such kind of scenario where we have fallen so much and we have much better place in terms of long-term compounding, right? Right. So this is the analysis we are trying to do here. Now let me go back to one screen which I again covered in one of the video, right? So there is a video, you can go to my YouTube channel and you can see why value screens don't work in bull market. That is where I have basically screen kind of stocks which in the bull market might look cheap, but if you see those companies, and there are all sort of companies listed there when this video was made. I think it's made in mid 2019, and if you see a lot of these companies which I've talked about, I think these are all now probably penny stocks. These are 1 or 2 rupee stocks, right? So again, before that, I'll also share one quick screen where I'll show companies which has basically fallen like this. So let's do a quick. Right, so this is the screen I generally like to look, and if you sort this, this shows basically the companies which has fallen from their 52-week high, right? So this is the percentage. So first company, say Cox and Kings, have fallen 99.55% from its 52-week high, right? So if you ask a layman, you probably think like कि 100 रुपए का चीज 1 रुपए में मिल रहा है, but we don't know whether it was 100 rupees worth of company. Maybe not. Even now it is expensive at 30 paisa probably, right? So ideally, I would suggest that we should avoid these kind of companies which has fallen in the middle bottom bracket, and this is what I was talking about. See the kind of value destruction that has happened in the peak of bull market. Some of the names which I showed in my video are it's there over here. Say this Kushal Trade Links is like 1.91, and when I made the video it was 22 rupees, right? The same with lot of other stocks. I think you can at leisure go through the video and also go through the screen. If you want, I can share the link post this session. It is very easy, but it is just sorting the companies by percentage of 52-week low, how much it has fallen, right? So you will see all sort of shitty companies over here in this list. You will see, your PC Jewelers, you will see Ecotech, Jet Airways, your D1 Housing Finance, your Manpasand Beverages, right? And a lot of these, again, I had discussed in one of the course which is known as, accounting manipulation, and this was taken in way back in 2018, and most of these companies were coming in those screens again back then. But it's just a matter of time these things happen, and generally people don't invest their time into learning, but they learn by losing money. So at least we should learn from what has happened in the past, right? And try to see how we can basically try to avoid these mistakes and be better off in the upcoming run whenever it happens. So again, idea is to be prepared. Right, so going back to the presentation, now a lot of people are waiting that let's wait for bottom, and rightly so. It again depends upon your individual risk-taking capabilities, but and the time horizon, of course, right? So people wait for the bottom. So for that, I have just made two interesting perspective, right? So one is your pure value kind of stock, right? And again, put in the parameters: low growth stock, which is growing at 5 to 10%, low ROE, and the business model is not that strong, but it is like moderate kind of company. So it is not totally junk, but it's a decent running company. It might have a very good promoter also at times, but the business model and the growth is not so attractive, and the industry dynamics are such that they don't make a good ROE or a long-term sustainable growth, right? So you can take an example of anything like telecom or say textile, where the dynamics probably are not too great, at least right now, right? So one aspect is those kind of companies where you might have a 70% fall in these kind of scenarios. So from 100 rupees, the company comes at 30 rupees. And these kind of companies probably recover slightly faster in the near term in percentage terms, right? So from 30 it could become 60. Again, the fair value might be 100, say for example, again just an assumption. So you might make 100% quick buck, but if you don't time it well, this 70% might become 80% or 90% very quickly, right? So in such kind of place where your time horizon is much smaller, right? You might want to time and find the bottom and wait for a bottom to take place and then enter these kind of companies. Now, here this is a second scenario where it's probably high growth companies. It can grow at 20-30% good ROE, ROC. It has already corrected say 50%. Near the bottom it might further correct 10-15%. It's okay. So probably in the near term this 50% return might become 30% return within 1.5 year, right? So probably you go down to 40 and then you come back to 65-70 in a near term, but then the compounding starts, and then in next 3-5 years your compounding helps you to make it like 250-300 kinds of amount, right? And if you again go to a calculator, just do 100 into 1.25, just doing a compounding of 25%, right? If you do 100 into 1.25 into 1.25 into 1.25 into 1.25 4 to 5 times, you will reach this number, right? So we are not even assuming a re-rating in a bull market. Just by earnings growth, you might end up much better off, say 5 to 6%, 6x return if all things work out. Again, there is no guarantee. As we all know, in investing, we might enter into a deep bear market, but this is just between scenario A and B, right? So whether finding a bottom matters in a value stock where you want to play for a shorter term, or in a high compounding companies where there might be some more pain, but then if your time horizon is longer enough, it might turn out to be well, right? So this is again comparison, and nothing is right and wrong. See, again, there are investors who want to make quick buck, who want to just get out in 6 months and make quick money and then deploy their money in compounders. Perfectly fine. There are investors type B who don't want to take that risk, who don't want to play positional, who don't want to look for a 6-month horizon and then be clueless where to invest my money further. That is where the category B is there, right? So that is where we should be focusing, where you want to be in the near term, and accordingly, probably you need to be position yourself whether you want to venture out in terms of finding a bottom, or you are willing to deploy in tranches as things pan out, right? Now, some strategies around this, right? This is again trying to choose, looking at the divergences, some of the charts, how to be in the right sector, how to be in the right size of companies and businesses, right? So if we go and learn from history, right? And again, Saurabh will take some deep dive into this, but before this, I thought I'll just show a quick picture in terms of how things panned out, right? So how we discuss about the first wave, similar thing happens in 2008, right? So green line is your Nifty, and your yellow and red line is respectively mid cap index and small cap index, right? So during the fall, the Nifty had a relative outperformance. The mid cap fall slightly higher than Nifty, and then your small caps were the one which got butchered badly. So this is the last third wave effect at the bottom of the cycle, where you see the difference in terms of this killing is huge. In the small cap index, the index itself got butchered by 80% from the top. Your mid cap got butchered by almost 70%. And your Nifty probably got butchered by 55 kind of percent, right? And these 10-15% of divergence makes a huge difference. And you can see that there was an initial bounce which was similar for all the three indices. But even in the longer run till 2013, until the riskiness was there in the market, the small cap index probably went nowhere. In fact, after the initial bounce, it again went back down, and there was a lot of pain probably after that, right? So the lesson is that, even if short term we might find bounces in small and mid cap or even micro caps, there might be overall issues in a longer run. Right? I hope the audio is clear. Right? One or two participants have just mentioned that audio is not there. If many of you are finding it difficult, let me know. If it is audible, just type yes so that it's okay. It's clear, right? All right. So let's move forward. So basically, it's not the time to adventure if you want to play for 3-4 years. Near term, if you want a quick bounce, I think then probably you can be rancho and play that space. That is what is the learning. Now second chart is basically when the 2014 probably start of bull run, when again people thought things will be much better in the new government and all those things, when euphoria started and risk took a back seat. That is where you see that your mid cap and small caps outperformed Nifty in a huge way, right? And in the peak of 2018, where you see probably the outperformance was like almost 100% versus Nifty, right, for the small cap index, and even the mid cap index was doing pretty well, and the divergence was much bigger, right? So this is where basically when you think that the overall risk from the market has gone down a bit, people are again euphoric, that is the time when again the switching could be done, in my view. Again, it is a personal risk reward kind of strategy, but this is again what history is telling us. And I would generally not bet against the market, at least when I know that something has happened again and again in the past, right? Now, a lot of people, this is again a common perception, that if you hold this kind of stocks, you are already down 50%, और नीचे जाएगा और कितना गिरेगा, right? And from 50% you fall 80%, you fall 90%. We should be cognizant that and prepared that things can go wrong. I'm not saying it will go wrong, it might improve, but the entire idea of presentation again is to be prepared that if things go wrong from here, are we prepared for it, right? So it's better not to venture out in those spaces where we can see further 10, 20, 30% falls if things go bad, right? And this is a quick math, right? That if there is 100 rupees or 1000 rupees for that matter, if we fall 5%, you need to have a 5.3% return to be a break-even point, right? Similarly, if you fall 20% at a portfolio level, you become 800. To recover, you need 25% of returns just to break even, right? Same way, if you are down, say 40%, that is your 1000 rupees become 600, you need 66% return to just break even, right? And same way, if you go down further in micro cap kind of spaces, if you are down 80%, you need 5x return to just break even. For 90% fall, you need 10x return to just break even, right? So just be cognizant about this math, that you might think that you have seen lot of advertisement and people on TV also talking about on business news channel कि यार एक महीने में वहां से 30% bounce कर गया, but if your stock has fallen 90%, even if it bounced 50%, it is peanuts, right? You need 10x returns to just recover and break even at your position, right? You see Bandhan just as an example again, from 700, assuming 700 was a peak, I am again not sure of the exact prices, assuming 700 was a peak and you fell to 150, if I remember correctly, right? You fell almost like 80%. So from this right hand side table, you need a 5x to recover, right? Now from 150, if there was a jump of 50%, you are hardly, just 30% into your original position, right? So you need still lot more to break even actually. So 50-60% is nothing when your stocks falls by 70-80%, right? And a lot of people don't get this math right, and this is very important in terms of protecting your overall capital, moving to the companies where you know there might be safe haven in a temporary phase, pull out some cash if you have so much of risky position, if your asset allocation is not right. Right, so this is again a simple snapshot, you know, how incrementally your percentage loss leads you to a higher recovery percentage to just break even. So this is very beautiful exponential diagram depicting the same point actually, that you know, just try to minimize drawdowns in such scenario, and better to rotate if you think that pain will last longer. So where we saw the sectors where things are most impacted, you know, ideally you should not venture out into airlines or PVR kind of place where you know there is possibility of huge drawdowns if things don't pan well in near term, right? And then it would be very difficult for recovering that capital, right? You can go 20% higher when things are clear, but if you are already down 40%, 50% from your entry now, it will take you forever to recover that losses, right? So that is very important point to ponder about, right? And this is again a survival point which I mentioned initially, that you know, we need to be in the places where we think that they will survive for near term with zero revenue, right? And this is a very beautiful technology adoption life cycle, but how I see is also in terms of companies. So on the left hand side you have innovators, which are more like your startups. Then you have early market, which are probably your SME kind of companies, some small cap companies. And there is a chasm, which basically says that not all these smaller companies are able to survive and scale, right? A lot of them die in between. And then some of them, those who survive, will kind of become slightly bigger by putting supply chain, IT processes into place. And then you find a phase of exponential growth, and these becomes even bigger, right? And then you basically mature companies like Infosys, and then they die down after getting matured, right? So again, in these kind of scenario, I feel that, you know, this is the red one is very risky space where companies might just get killed, you know, because of high debt, because of smaller scale. Banks might not lend them in near term. They might struggle for working capital. They might struggle to give a long standing credit to their suppliers or their customers. All these issues can happen, and these companies, you know, forget about your DCF and your terminal values. These might not last for 1 or 2 years, right? So we should be uh, cognizant that there are severe risks in such times, and we can position accordingly. Ideal places more like these kind of companies which have demonstrated things in place. They have demonstrated earnings growth, or they are mature companies which are much stronger. They might not give a phenomenal return in near term, but then at least you have a survival in place, right? So these are mostly companies which have reasonable valuation with demonstration of good growth, good strength of business model, and good strength of balance sheet, right? Growth at reasonable price. This is where we should be ideally focusing if we have decided to rotate or put our new money into the market. Now this is again a more before we try to see what kind of business model and parameters we should be looking for these kind of companies. There is very small explanation of compounding, right? And you might have seen this slide where we discussed. I'll go back to this slide again, right, where we discuss A and B, right? So this same concept we will try to understand in a normal parlance, right? How we are doing FD. So you might have 100 rupees which you wanted to book as a FD, right? So this is the leftmost box where your principal is 100. Now inflation is 5%, so your cost is going to up by 5% in the next year. So your 100 rupees next year will be equivalent to 105. So as far as you earn 105 rupees next year, it doesn't matter much, because today one trouser which you are able to buy 100 rupees, that will become 105 rupees. So you will all obviously be able to buy the same trouser for 105 rupees next year. So 5% interest rate is a break-even point where you will decide whether to invest or not, right? Now, assuming that you are getting 10% interest rate in your FD, right? And those days are gone, I know, but just for simplicity of the calculation, assume that you are getting 10% interest rate. So here you are better off. Next year you will get 110 rupees credited, assuming post-tax amount, right? And you are able to get the same 100 rupees thing for 105 rupees. So you save 5 rupees, right? So this is fine. So far so good. This is a concept of basically return on equity, how much amount you are getting, right? And if you think about inflation, it is more like a cost of capital, right? So if you are able to earn more ROE than your cost of capital, you are better off in terms of compounding. That is what is the first concept I am trying to drive. Now second concept is your interest. You have received 10 rupees of interest. Now suppose the interest rates are dropping. You are no longer getting 10% interest rate. So your reinvestment rate is probably 10% or 5% or 4%. So what is better for you, right? If it becomes 4% and your inflation is still 5%, whether the reinvestment makes sense or no? It doesn't make sense, right? So that is the reinvestment opportunity of the company. That is where your incremental cash flow deployment of the company comes into the picture. Whether a company is able to reinvest profitably into any new venture. So say for example HDFC AMC, right? It earns its profit, it pays the salaries to the fund manager. They don't have anything to put their money, right? They have to do a FD of 8%. And that is it they can do, right? They cannot do anything about their money, right? So the reinvestment opportunity for such companies is very low. Now there might be some other company like L&T, say for example, that they have made a plant in one place, right, and they earn some profit out of it. They can again reinvest that money to open a new plant in a new geography or probably in a new product line and deploy that cash at a much higher level. Again, the second question comes is, what is the interest rate for this incremental amount? And that is your return on capital employed, right? So again, assuming we are only using equity, right, your cost of equity should be lesser than the return on the capital you are employing. So any new reinvestment you are doing, that should be at a higher ROC than your cost of capital or return cost of equity, right? Assuming it is just funded by equity. So that is second parameter, right? And the third parameter is growth, right? If my interest rate in the principal itself is growing at much higher rate, right, then basically whatever I'm putting money, whatever 7% or 10% or 15%, this 100 rupees itself which I'm able to put from my salary or whatever, it's increasing at a faster rate, right? It is 100 right now, next year I'm putting extra 100. So my own growth from the company is enabling that faster compounding to happen, right? So same concept we will try to understand in a fundamental sense for the companies, right? And again, this becomes important in this point of time because we might be knowing this concept of how companies compound at a good growth rate, but most of the times we have questions around valuation, and probably this is the time to be prepared when we are probably going to get a cheaper valuation or at least a reasonable valuation to get into these kind of companies, right? So the left hand side is a business model trinity which we should be looking for. One is excellent growth. Your reinvestment rate should be greater than cost of capital. You should be able to reinvest most of your cash flows and good ROE. These are the three on the financial side, and then more subjective side would be your longevity of growth, how long you can grow with these kind of things in place. What is the valuation you are getting into? What is the robustness of the business model in terms of survival capacity to suffer? How is the capital allocation of the management, and how capable and prudent is the management, right? So left side is basically more on the financial side, the fundamental parameters, and the right side is more of a subjective parameters, but fundamentally again very important. So I tell it as a fundamental compounding trinity, and we'll see again an example how to find these kind of companies, right? So this is one example where you find good sales growth. So this is a 10-year performance in terms of sales growth, where company on a 10-year basis have grown sales by 30%. Last 5 years have grown by 20%. Here if you see, although the sales growth have slightly tapered recently, but that has been compensated by margins expansion. So overall your profit growth is broadly 30% CAGR for 10 years. Last 3 years almost 25% CAGR. And your return on equity, which we discuss about, that what you are getting return, whether it is above your cost of capital, above your inflation in a normal parlance, that is pretty decent. Your generally cost of equity is around 14-15%, 13 to 15% in this kind of scenario. So second parameter is it is debt free. So your borrowings is zero in September 2019. And the third parameter is this, basically your operating cash flow, and we'll go to this example, right? So your operating cash flows more or less are getting deployed in investing, right? So basically you are able to reinvest your cash flows very efficiently, most of them at a very high rate, and that will be depicted by your ROCE. So if you see ROCEs, you are basically able to redeploy your newer cash flows at a ROCE of 20% plus, and that you are able to do for almost like 80-90% of your cash flows, sometimes even more, right? And that you are able to do it for like 8-10 years, right? And you can see how these kind of companies compound, right? So basically the idea is, if you are able to find these kind of trinity, if you are comfortable with the parameters of sectors which we discussed earlier again, then just wait for a right valuation. And if you think that your valuation is good and there are no headwinds, like how I mentioned in case of severely affected sectors, if you think there are no headwinds in the near future, I think these are the places we should be prepared for ourselves, right? And then on the top of it, try to see if there are these growth drivers in place in the near term, right? And these are the 4 major parameters which basically trigger high growth, supernormal growth in a phase period, right? So if you find these kind of triggers, then you can average up these kind of companies when it shows those signs, and your price volume action also confirms that. This is one of the, again, strategy which I would usually do. Again, my personal perspective, but hope this is again resonates with your overall philosophy as well, right? So it's important to study carefully the price action of individual companies with new positive developments and strong earnings per share during major market declines. So this is exactly what we are talking about, that try to see if there are a deviation, if there is price volume action, if there is strong earnings momentum, if there is a strength which you can see in a company, in a sector, which are rebounding in these kind of market declines, then those are the upcoming next cycle's super performers, right? So this is the quest we should be all looking for. This is a small example again from a US listed company, and why I have taken a previous example is again to see that historically that has happened, right? So if you see here, this is peak of 2008-9 bear market, right? And we know the bear market bottomed somewhere in March, right? In 2009. So in March 2009, this is by the way Netflix, right? So Netflix made an all-time high, and I'm not talking about 52-week high. It made an all-time high, and the low of Dow was almost 6469, which was almost the lowest point on 8th March. And just after 10 days, this company made an all-time high. And the earnings strength of last 3 quarters, the growth rate was 36%, 38%, and 58%, right? So it had a tremendous earnings growth. It just showed a new all-time high, and even if somebody would have got it at all-time high and invested for next 5-10 years, right now it's like almost 60-70 times, and I think probably in last 2-3 months it has gone even higher. This is slightly dated chart from December, but this is the kind of divergence you should be looking for. This is the kind of fundamental earnings divergence you should be looking for, and blend it with the technical price volume action. That is where you will be able to find the next winners. Right, so this is all from my end now. I'll hand it over to Saurabh. He will take you to the learnings from history.
So thank you, Vivek. Thanks for bringing all of us together, and thank you everyone for your time. I'll be briefly speaking about the learnings from 2008 crash and the post that what happened. Now, why this motivation came? So we always social media on Twitter, on WhatsApp, a lot of things like things which call don't catch falling knives, or every bull market comes with new set of leaders, or what to do in such times when there is a free fall across the indexes, and many of us are not enough to to go through past cycles, because maybe we are younger, or we have started investing only from last few years, and certain things comes out of experience. How we get that experience, and one of the way to get is go through that data and look through the data, and feel as if you were there in the market and see what happened, and then try to learn from it. So what I have done is, here is an experiment which I did. The objective of the experiment was to find the patterns of wealth creation and wealth destruction in such panic times. Also, what are the sectors we should avoid, and what are the sectors where we should look for opportunities. Is there anything to infer from the recovery and falling intensity of companies and sector learning from the past, and taking all that learning from one of the previous crises, how it can help us in building our current portfolio strategy. Second thing, this is a work of generalization, and by generalization I mean I may not talk company specific, I might talk in company clusters, or I might talk as profile of companies belonging to certain bucket, and whatever insights you might see, these insights might be varied at a bucket level, but there could be outliers. So let's say if I say in this bucket 10 companies will give you minus 60% return, it doesn't mean all 10 companies will give minus 60%. 8 companies might give minus 80% return, and 2 companies might give plus 40% return. So the idea is there could still be 2 companies in that bucket which can give plus 40% return, but then it means your odds to succeed is 2 out of 10. So you should be able to remove 80% of the companies from your watch list, and that is not going to be the easy task. And third, for this exercise, only those companies were considered which had more than 6 months of training data across 2007 to 2011. So if there is any company which was newly listed like in end of 2007, or it got delisted, all such companies have been removed. And finally, we had totally 996 companies which were analyzed. So there was a tweet which I did 2 weeks back where you can see the below this chart which you are seeing, this table. So what this tweet said is, I tried to place 96 companies in bins, and these bins are percentage of fall from the 2007 max price in 2008, and some companies fell by less than 20%, some 20 to 40%, some 20 to 40%, and some more than 80%. And this was an analysis of, let's say, once it fell, how many companies were there, what was the distribution, and if you take the 2007 value as a base value, in the end when you invested in some of these companies, what kind of returns did you make on 1 year, 2 year, 3 year basis? And there are multiple ways to do it. You can take a 2007 maximum price, and then you can analyze by 2008 maximum price, 9 maximum price, 2010 maximum price. You can take a minimum price, you can take a average price. There are multiple ways, but I just try to give few perspectives. And that exercise was just exercise of just showing one thing that, go by, if something has fallen so much, it is going to make money. In fact, the analysis was reversed, and the other, which was companies who fell very less, they were the company who gave most of the return, Whether you invested in 2007 or you invested in 2008, it didn't matter. The second thing was the companies which fell less than 20%, only 6 out of 996 companies fell less than 20%. Even if you go 20 to 40%, only 20 companies. So out of 996 companies, only 26 companies, fell less than, 40%. And that is like not even 1% to 3%. So it is very, very difficult. But then I got lots and lots of questions regarding sector and what is the trigger point, which sector they belong to, what companies they are, can we identify some behavioral pattern. So I went and I did some more deep dive, which I will present in next few slides. So first, what I did when I redid this exercise, I divided into 4 buckets, 0 to 20% fall. In fact, I had 5 buckets, no fall, but there is no company which, there is not even a single company whose 2008 minimum price was higher than 2007 highest price. Not even a single company. So ultimately I got 4 buckets, 0 to 20% fall, 20 to 40%, 40 to 60, and then that 60 and 80 and all I combined and it's more than 60%. So 82% companies fell more than 60%. A handful of 4% companies fell less than 40%, by less than 20% out of this 996. The second thing, this table which you see, this table is all these 996 companies distributed across sector, and then what is the percentage of these sector companies which fell more than 60%, 40 to 60, 20 to 40 and 0 to 20. There are only few sectors which could wither this kind of butchered performance. FMCG, chemical, healthcare, agri, they had at least 10, 15, 20, 30% of the companies which fell between 20 to 40%. And all other sectors, you had more than 60% companies, or more than 80%. In fact, in some sectors, like if you see reality or power or aviation retailing, 100% of the companies fell more than 60%. And telecom and banking, they were somewhere in the middle. It was not as, as strong as the FMCG healthcare, but they were not bad also. They were somewhere in the middle where, so looks like whenever, these kind of situation happens, the FMCG and pharma, they are like front runner and showing strength. In past cycle, even rating companies did well, but right now we know that rating companies, they have gone through their own cycle after IL&FS crisis. It was surprising to see for me that chemical companies were relatively stronger than a lot of other sectors which we talked about. Going to the next slide. So what were these companies and can we find a pattern? So few small financial KPIs I would like to show. So again, the top right table which you see is you have these 4 buckets, 0 to 20% fall companies, 20 to 40, 40 to 60, and the first row is more than 60% fall. If you see the average ROCE in 2008 for these 4 buckets, you will see there is an inversely proportional relationship. So the companies which fell the highest, their mean ROCE was lowest, and the companies which fell the lowest, their mean ROCE was highest. And in fact, as you go from highest fall bucket to lowest fall bucket, you see the ROCE is subsequently increasing. So it looks like ROCE, which is a representation of quality, has an impact on the resilience of the cluster of companies which show differentiated performance. The other thing was, we always think of let's buy a very high dividend yield stock because 9% तो dividend नहीं मिल रहा है, stock ऊपर गया तो फिर additional gain है. But what it looked like, dividend yield didn't have any kind of correlation with the percentage fall and also the returns which were met. The third thing was price to book value. So one learning for me is, many times in such carnage, what looks cheap by value or by the pure play asset, that may not be something which will give a very good return. And if you see the mean price to book value of each of these 4 baskets, the best performing basket which fell the least, that had the highest price to book value, and again the reason could be attributed to maybe because FMCG and healthcare and pharma and all such. And the basket which fell highest, that had lowest book value. So there are certain metrics where we can see there is some kind of trigger, there is a relationship, and certain metrics like dividend, I think this is not at all sufficient to say anything. So this was till the characteristic of, till the fall was happening. But let's say once the fall has happened, post the crash, what happened in terms of recovery and what kind of companies did well. So if you see the below table, this below right one table, what I have done is I have tried to give two CAGR ratios. One is average of 2007 to average of 2011. So what I mean is, let's say every month, at the end of the month, you take the closing price of these stocks, and every month you do an equated SIP in that specific company, and all the companies which fall in each of these four clusters, you do this. Then you hold it for 4 years, and in 2011, every month you do an equated selling. Then what is the kind of CAGR you have met? And the same thing if you do in 2008. So why I'm taking 2007 and 2008 is 2007 was like the peak of the bull market. So if you invested at the peak of bull market, what kind of returns you would have expected in 2011? But then somebody told me, I know these companies fell by 80%, but what if you invested those companies in 2008 because they have fallen by 80%? Did you create returns? So that is why I have the second column, which is from 2008 average, same thing. So we will see both ways, and if you see both ways, the companies which fell more than 60%, whether you invested in 2007 or 2008, you didn't make money, and these are CAGR returns. In 2008, the losses are lesser, but in 2007 the losses are higher. It's like after 4 years you have met 36%, minus 36% absolute return. But even if you buy after falling 80%, 90% in 2008, you didn't make money. And please note, these companies were 82% of the basket. So 82% of the basket didn't make money even after holding for 2-3 years. So ideally, again, it comes back to what makes money is the same set of 20% companies, and those 20% companies are lying here, which have fallen 0 to 20, 20 to 40, and 40 to 60. And then if you see the companies which fell 40 to 60%, even if you invested at the peak of bull market in 2007 through a SIP mechanism at every closing month, still you made a decent 13% CAGR. And if you invested in 2008 after they have fallen 40 to 60%, your CAGR return jumps by almost 1.7x. You will generate a 20% CAGR. And if you invested in these two buckets, which is very low, it's like there are only 38 companies in 0 to 20 and 20 to 40% bucket. If you invested in this, still, you made somewhere around 22 to 26%. So looks like if you invest at the fall of at the bottom, even in a SIP manner, if you are able to hit this 15-18% companies, you will generate decent 20% return. If you are investing at the peak, maybe in some you will make lesser return, like this 40 to 60% basket is 13% and 0 to 20 is 24%. This is like just a 2x performance, whereas in 2008 the performance is not very different. It's 20, 21, 26%. So the idea is to identify those 15-18% companies, which are better, and we have some insights in terms of what kind of sectors they belong to. We have some insights in terms of what kind of ROCEs they hold. I have not shown a lot of other metrics like leverage and all, but I will give you a list of companies. Try to go through the list of companies, see what kind of working capital they had, see what kind of leverage they had, see what kind of shareholding pattern they had, and there's a lot of learning lying there, and you'll be able to appreciate the kind of features and the kind of profile these companies have, so that you try to find those 10-15% bucket rather than chasing the rest of 85, which is not going to create any money. So the idea is, if this is the market, this is the population of 100%, ultimately those 18% companies are going to make money. So the odds to success is 1 out of every 5 company which is going to make money, and that too when you buy at fair valuation. So the current market and 2000 market is very, very different, and let me highlight it. So next slide, you see these are the wealth builder companies and these are the wealth destroyer companies. So these were some of those 38 companies. So I have not taken the full list of 130 companies at 18%. I have taken the top 2 baskets, 0 to 20% and 20 to 40%. So these were some of the companies, like in FMCG you had Britannia, Dabur, Glaxo, ITC, Marico, healthcare you had Apollo Hospital, Cadila, Cipla, Lupin. Then chemicals you had paint companies, Asian Paints, AkzoNobel, Coromandel, Sudarshan Chemical, and few companies like Airtel and Page Industries. But the thing to note is, if in 2008 you invested in, let's say, Asian Paints, Asian Paints for the whole 2008 it was available below 30 PE and sometimes at 20 PE. So even if you take a mean PE of 25, in 2008 if you invested it fell less and then it gave you like the decent 30-35% CAGR. That happened because it was available at a PE of 25. Right now, after the current fall, whatever 20% fall has happened in Asian Paints, still Asian Paints is available at 50 PE, which is 2x than what happened in 2008. So now whether the whole thing will repeat in the same way or not, it depends a lot on the valuation also. So even the quality is there, the ROCE is there, the features are there, it has fallen less. The next question should be asked is there enough margin of safety to get that kind of return which we got in 2008? So all said and done, still be very cautious about the valuation because this is the last lever, but this is also a very critical lever. And from this perspective, this current market is still not same as 2008 market. So as Vivek said, we might be still in a stage 2 and stage 3 might happen when the mutual funds start selling and when the best of the companies they also start crashing. Maybe if that happens again, maybe we might be getting again Asian Paints at 30 PE, which again might replicate the kind of fall we saw in 2008. Because still in this market, the large cap has not fallen that much. I mean, if you see, Vivek showed the large cap index was also 55% down. Right now, the large cap index is just 25-30% down. So it might happen. So we need to be cognizant of the valuation part also, apart from the overall quality and the price movement story. The other side is all the wealth destroyers. So 82% companies, like we had some 700 wealth destroyers. I tried to take the top ones, and some of the names because I was not actively involved, but I have seen the 2008 market and novels. But I know these were some of the stocks which were like coming every day on CNBC, the Goldstone Technology, Tanla. I think again last year it came a lot of limelight because some political party is going to support and all, and the business is going to revive. Ashapura, MIC Electronics, PL Kashyap, the story. Allied Digital, it was sold as an infrastructure. So in IT also it did a lot of wealth destroyers. And Allied Digital that time the RIMS, remote infrastructure management was the buzzword. Like today we have the deep learning and artificial intelligence same way. And this was one of the companies which was like trying to be projected as the poster boy. And see the kind of wealth crash they had. A lot of these companies I don't even know if they exist right now. And these were the companies who went through the massive correction and then they couldn't come out of it. So the idea is to understand the patterns of which companies will survive, which companies will be strong, and then which companies will be able to give better return by combining the price data, price movement data, by combining the fundamental profile of these companies, by combining the valuation, and also by rejecting where we shouldn't get into. So that's all I had from my side. I will again hand it over. Again, thanks a lot for your time, and it has been a great Sunday. Thanks, Vivek.
Thanks, Saurabh. I think you can just keep your screen off if you have not removed it.
Sure.
So just go to next slide. Yeah. So basically, the idea is, guys, each new bull market has new sector leader, and this is again just a summary. In 2008 cycle, we had infra, construction, real estate, and power, which were the cycle plays. And then we saw financials, pharma, chemicals, and consumer auto were the best performing sectors in the last bull run. So we have to just be open to it, be prepared to it, that which are the new sectors that are coming up. And as I said, there are various ways to do a price volume action based analysis and also to see the divergences in terms of price. I again use my own kind of screens, and again that is very big topic in a short period of time, but idea is basically you should have your own methods to judge which sector is trying to make new highs, trying to form all-time highs, and be in those sectors in maximum of your companies in your portfolio. Next slide, please. So yeah, just align with yourself with powerful force. Try to see that you have tailwinds in your favor and not the headwinds. So try to stay away with the sectors which are facing heavy headwinds. although it might seem cheaper, but they can fall further 20, 30, 40, 50%. We don't know, right? And we also showed the table that if it falls 50, 60% more, the kind of returns you require to recover those losses are massive, right? So it's better to have a notional losses rather than to have actual losses by just missing out on those sectors. So it's prudent to just be away and cognizant of the strength and be with the strength rather than just fighting with the market and trying to be in the sectors and companies where clearly people are not comfortable with. A lot of big investors are selling. Let's not try to just fight with them and be on those sides. And again, on the small cap and mid cap and micro cap, again same idea, that if the wave 3 plays out, these will be the companies which will further get butchered the most. So let's try to be cognizant about these risks. If you are kind of rancho who want to take that higher risk higher return kind of approach, good for you, but at least you should be aware what you are getting into and how you are going to play it, right? So that's the basic overall conclusion of this entire presentation. I think we are done. Saurabh, just can you go to the last slide, please? Yeah, so again, disclaimer, please don't take any example as a recommendation. Please do your own research. And again, these are all data points which we are shown from the past. The future might not pan out as exactly same as how it panned out in the past. So that we all know, and we can't probably do anything about it, right? And the data analysis is again our own. There might be glitches in terms of some data or accuracy of the data. So please be mindful of that. And again, these are our own views. Please feel free to have your own views and venture out accordingly. So with this, we are just closing this session. Yeah, so thank you and always be humble.
Thanks for watching. Do share and subscribe the video channel.